Thank you. And thank you for the invitation to join you and make some comments today. Maybe you could give me like 15 minutes. I'll drink a lot of water and rely on natural forces to bring this to a close on time, perhaps. So in thinking about Ramiro's 4 questions, I think I have comments that will relate to each of them. What's the interest rate trend? How should we think about the balance sheet of central banks on valuations? Is globalization at an end or in a trend change? And then the impact of automation and technology on labor markets. That 4th question, I probably won't say much other than to say that we do now deploy robots at Fannie Mae. And it is interesting to watch a robot run spreadsheets. It scares some of the economists at the company, I might say that. So let me give you a little bit of a brief backdrop so that you can understand the context. See if I can get the pointer going correctly here. Where's the pointer? That basically just says Fannie Mae will deny that I was ever here. But let me give you just a little bit of context in terms of where government-sponsored enterprise debt resides in the larger picture. So this would be outstanding government debt globally. As you can see, within the United States, about $20 trillion. It's about 32% of the entire market, Japan being next. And then within dividing that share of U.S. debt into its components, you can see that GSE debt down here. Let's see if I can. How do I get to the pointer? Otherwise, I can. Oh, that's all right. I'll just walk over and point. Oh, you had your own. Oh, one of those little things. Thank you. This is great. Okay, much better. Okay, thank you. So relative to U.S. Treasuries, you see that GSE debt is roughly about half the size of the U.S. Treasury portfolio. This GSE debt includes other kinds of government-sponsored enterprises other than Fannie Mae, Freddie Mac, and Ginnie Mae. I'll talk about that a little bit. It also includes the Federal Home Loan Banks, and there are a number of smaller GSEs. So it's not just related to the housing GSEs. A little bit of history. Those GSEs were actually founded back in the 1930s. FHA, the Federal Housing Administration, which introduced the 30-year level payment self-amortizing mortgage, was founded in 1934. Shortly thereafter, Fannie Mae was founded. And then in 1968 was split into Ginnie Mae, which has the full faith and credit of the U.S. government behind it. It was Ginnie Mae, and then Fannie Mae was spun out as a shareholder-owned corporation, which does not have the full, it has only the implied faith of the government, which has become more directly secure with conservatorship, which happened in 2008, and which continues to today, awaiting either a legislative or an administrative fix. And on that front, not too long ago, speaking at an event, I was introduced as the extinguished chief economist of Fannie Mae. So I'm glad to be here today. It's backed, of course, by the U.S. housing market. So just to give a sense, there are 76 million households in the United States that own their home, of which 47 million own that home with a mortgage. In an individual year, for example, in 2017, there were about 6.1 million transactions in the market, which resulted in about $1.8 trillion of mortgage originations. Although some of those are securitized, some of those are not. So what happens in the securitization space? So over here you see the total of about 10 trillion, or 10 trillion, 10.5 trillion outstanding, of which about 67% are securitized in terms of single family homes, meaning that whole loans are about $3.5 trillion, held primarily by banks, but also by other investor groups. On the apartment side, there are about $1.3 trillion of apartment fundings outstanding, and slightly less than 50% of that securitized. So my comments will be focused primarily on the single-family home side of the equation. How is that spread between Fannie Mae, Freddie Mac, and others? You can see Fannie Mae has about 42% of that securitization share, about 26% Freddie Mac, and about 26% Ginnie Mae. Ginnie Mae is the guarantor of loans made by the federal or insured by the Federal Housing Administration and guaranteed by the Veterans Administration. That's primarily the collateral of Ginnie Mae. Now, who holds those within the U.S. or outside the U.S. to give a sense of the global reach? You can see banks and credit unions, about 27% of the securities, about 20% in the Federal Reserve, and it is the single biggest investor in mortgage-backed securities as an institution in the world. And then foreign holdings of U.S. Mortgage-backed securities is about $1 trillion. That's primarily held in Asia. So you see in Taiwan, in Japan, in China, and then Asia less China, Japan, and Taiwan, this group. So primarily held in Asia in terms of foreign investors. These are some of the other smaller government-sponsored enterprises. Now, from a trend line, what you see here is the peak of first lien closed-end mortgage debt outstanding at the point of the crisis. There was some decline, but again, we've moved up close to that peak in the intervening decade as it has passed. You can see the distribution of who's holding the securities by groups, again, banks and credit unions, fairly stable over the long run, a slight rise, but fairly stable. The growth in the private label securities being the largest contributor to the growth leading up to the crisis and having subsided significantly since that time period. Two things I would point out here. One, this is the Federal Reserve, which you see didn't exist as a holder of MBS prior to the crisis. And the second one is this line right here, which is the holdings in portfolio of Fannie Mae and Freddie Mac, which by law now are required to have shrunk by this year to a combined total of something in the $600 billion range from about $1.3 trillion at the peak. So if you went historically at who held mortgage-related debt in the United States, if you went back to the 1930s, you would find it was insurance companies because a significant share of the population was housed on farms, and they were a large investor in farm real estate. So if, for example, the Mortgage Bankers Association, which represents mortgage lenders today, was initiated in Chicago as the Farm Mortgage Bankers Association. That was transitioned into the thrift industry or the savings and loan industry, which until they approached bankruptcy in the 1980s were the largest holder of mortgage assets. With the decline of the thrift industry, it became the portfolios of Fannie Mae and Freddie Mac, which were the largest holders. And with the crisis and the legislative decline in their portfolios, the Fed substituted for that. So it opens a question related to interest rates, that when the Fed backs out, who buys? And when they buy, at what yields are they going to buy? And where will that debt be held? So you can see there the decline in the GSE portfolios going forward. So a couple of things to think about here in terms of current credit risk. If you look at credit scores, the average credit scores in current production, this being 2017, much higher than you would have seen prior to the crisis. You see FHA and VA as significantly lower credit scores. There's more of a subsidy implied there for first-time home buyers in particular that is served in the FHA arena. This is a chart that shows the relationship between the 10-year Treasury and the rate that are paid by consumers when they take out a mortgage. As you can see, that's called the primary spread. And as you can see, that's been relatively constant pre and post. But there's been a shift here. The primary secondary spread widened out and the secondary spread narrowed. That's a function of the Fed's buying, and I'll come back and talk about that in a few minutes. One other factor that you're going to see that's related to Fed policy is this, which is the primary spread, that is the rate paid by consumers relative to the U.S. 10-year Treasury. And you can see that's now at the lowest point since late 2011, and I'll talk a little bit more about that as well. So with that, let me address that little bit of backdrop. Let me address four things. One is the future of the GSEs. The second is the Fed. The third is how to think about the future and changes that are underway in the market. And then fourth, what we think all this implies for mortgage rates and the housing component of the U.S. market. So the future of the GSEs. Well, we see reform. At present, the view is that, and the law that was passed to put us into conservatorship suggests there needs to be a legislative solution to release us from conservatorship. That appears to us to be unlikely. It ebbs and flows in the policy conversation in Washington. The odds may be the largest that they have been, or the greatest that they have been for some time right now, because the current Treasury Secretary has made his entire career in the mortgage-related space, either as a bond trader or as the owner of a bank, which had a significant mortgage portfolio. So well informed on the workings of the market and the meaning of some of the options that are being put forward. That does not mean that that will rise to the top of the legislative agenda, and it works against two forces in the United States Congress. One is the force that believes that the GSEs should be closed and funding of housing should be done entirely in the private market with no government intervention. And the other side is the population that believes that housing is a social good and requires significant subsidy. Those two ends will never meet. The question is, what happens in the middle? And in our view, it's really, to the extent they still exist, in the lap of moderate Republicans to bring closure to that deal. But as I said, that kind of depends on the degree to which they still exist and whether or not that rises to the top of the policy agenda to solve that. So there is a theory that the regulator has administrative authority under the law to actually create an exit strategy for the GSEs. Whether that will get tested or not, I have no idea. But the earliest at which such an idea would be tested would be post the midterm elections, and depending on the outcome there, that will change the odds of something like that happening. I would say it's unlikely that whatever the future system looks like, that it would not support a 30-year fixed rate mortgage. There's probably a 95% consensus in Washington and in the population at large that is a necessary feature of the US housing market. So I would not expect to see a structural change which would minimize the opportunity for that mortgage product on the part of consumers. Now, I would say there is one other related regulatory issue that has potentially a minor, but maybe not so minor impact, and that is in the bank reform legislation, there is something called the liquidity coverage ratio, and Ginnie Mae securities are treated the same as cash by a bank in meeting your liquidity coverage ratio. And to the extent that there are liquidity challenges, you may see demand for mortgage-backed securities move slightly to the Ginnie Mae side of things, which would improve pricings for borrowers who take out either VA loans, Veterans Administration loans, or FHA loans. It's a minor point, but it will also be impacted in the regulatory space. So what about the Fed? how does the Fed think about things? First of all, did it work? That's a point still being debated, the impact. And one of the things, we wrote a piece in the Journal of Structured Finance last fall and said, well, a couple things. One is, to the extent that the argument was that the Fed's purchase of mortgage-backed securities drove down rates and achieved their objectives of putting a floor under house prices, therefore reducing the decline in the wealth effect felt by households who own a home and have equity in that home, or bringing rates down to allow for the refinancing and improvement of the cash flow of households, then those are the claims about the purchase of the mortgage-backed securities. But there's been relatively no discussion of the reversal of that. And will, in fact, the reversal of that be simple and inexpensive? And so that experiment's now underway as the Fed has stopped buying to replenish its mortgage-backed securities holdings and are allowing that to run off. So one of the governors at one point said that their view was that would be watching the portfolio run off would be like watching paint dry. I've personally not sat and watched paint dry, but my guess it will be somewhat more interesting than watching paint dry. So one other question, a question related to that then is, who buys and at what rate? And does the Fed completely close out their portfolio, or do they retain a share of mortgage-backed securities and the mechanisms for trading them so that they retain the optionality of using MBS in the future environment, given some of the discussion that will take place here about just where nominal and real interest rates are going to go and how much ammunition the Fed is going to want in terms of its total set of tools for the next recession. As I pointed out to my wife, I said, every expansion has eventually ended. I used to say, all bleeding eventually stops. She thought that was a little excessive. So I think those are a couple of questions that are going to be answered in terms of, and I think I had one more. Thought I had one more chart I wanted to show you. Yeah, this just in terms of the composition of the Fed's portfolio. So there's a question of how large the Fed's portfolio will ultimately be when the mortgage-backed securities run off. We're more in the kind of the $3 trillion range ultimately, a little higher than some others, given the things that they must accomplish. But we do think that they will run at least most of their mortgage-backed securities off. Although you'll note, to the extent that their changes in monetary policy put upward pressure on rates, that will slow the pace at which people prepay their mortgages and may potentially cause them difficulties in seeing the portfolio run off as rapidly as they might desire. So what about the future? So one of the things that has been done within the government-sponsored enterprises is the creation of some new securities called credit risk transfers. The idea is to share more of the credit risk with private investors and reduce the potential liability to taxpayers in the process. So that we have a target of seeing most of the mortgage-backed or of the mortgages which we guarantee being backed by credit risk transfers in the not too distant future. The one thing I would say there is this is a relatively new product. The number of investors in this is not anywhere close to what you see as the number of investors in treasuries, and it has not been through a cyclical test. So one of the unknowns is, when we go into that next recession, what will investors price the sharing of that credit risk with, or at? What will the price that they'll demand to participate in that space? And you may see some divergence at that point, depending on what's happened on policy for the GSEs relative to, say, Ginnie Mae. You may see some shift in terms of the investor appetites between those two categories of securities. There's also a move to create a single security backed by loans guaranteed by Fannie Mae and Freddie Mac simultaneously. That's an attempt to reduce the subsidy in Fannie Mae securities, given that the liquidity are in Freddie Mac securities, given that the Fannie Mae securities trade at about 7 times the pace of Freddie Mac securities. So then a final thing, how are we doing time-wise? Okay, so a final thing, I want to go back to a chart. I'm shuffling between these two things. I grew up on a dairy farm, and my father used to say, if it has more than 2 moving parts, don't call Doug. So let me go back. Oops, I'm going the wrong way. That's why he said that. To this chart right here. So first of all, the mortgages outstanding in the United States, about 85% of them have an interest rate between 3% and 4.5%. So it's a very narrow band because of the long pace of policy-induced refinancing. And we're now at about 4.5% for a 30-year fixed-rate mortgage. Now, we did a stress test within the company of a 50 basis point rise. This was last September, of a 50 basis point rise in mortgage rates. And what would that do to refinancing loans and to home purchase loans? So the impact of that 50 basis point rise on refinancing loans was to reduce the volume by 50% in the first year and another 23% in the second year. On purchase loans, based off of the base run rate of purchase loans, it only generated about a 2% decline in the pace of production of purchase loans, because the motive to buy a home is very different than the motive to refinance your existing mortgage if you have one. Now, the reason I'm showing you this chart is we also survey mortgage lenders on a quarterly basis, and for the last 2 quarters, they've been projecting on their 12-month outlook declines in profits, and that the number who are projecting declines in profits is the highest since we started the survey about 8 years ago. And their answer for why the decline in profits is competition. So that decline in refinancing activity is generating serious competition, which is leading to this decline in the primary spread. The history of the mortgage lending industry in the United States is when there's a cyclical turn in the rate structure, there's about a 6-month period in which lenders will subsidize, they'll run at a loss in order to attempt to be the one that's able to stay in the business after industry capacity is shed. So that's underway right now, and you're starting to see mergers and acquisitions take place. You're starting to see layoffs take place. So what they're doing is they're shrinking the spread today, attempting to be the one to stay in the business. About 6 months from now, that spread's going to widen out, which means street rates to consumers are going to start to rise again. A second thing is when we look at who's going to replace the Fed as the buyer of mortgage-backed securities, the fact that the Fed was able to purchase them away suggested they were paying, at least initially, higher returns than what the investors expected they were going to get on those securities in the marketplace. But at some point, as we look at the portfolios of who the traditional holders of mortgage-backed securities, the yields are going to have to go up to attract the incremental buyer, and we think that's the 3rd quarter of this year. So then you'll have this spread widening, you'll have yield requirements by mortgage-backed securities investors. Those are 2 upward pressures that you'll see on mortgage rates relative to treasuries. And the third thing is I showed you that widening of narrowing of the primary and secondary spread. The fact that the Fed bought into the MBS market opened the door for our regulator to have us increase guarantee fees on mortgage-backed securities. That will not reverse itself when the Fed exits. So you've really got 3 pressures that are going to raise mortgage rates, irrespective of what happens to the 10-year Treasury, which is the underlying instrument under the mortgage space. So those are three things I think that are worth noting on the interest rate front, not specific to treasuries, but to a very significant part of the U.S. economy. So with that, let me end my comments and take a couple of questions if there's time.
Doug, thank you. Great presentation as always. Regarding the duration of the three categories of government securities, so the Fannie Mae, the Freddie Mac, and the Ginnie Mae, what's the average duration of those different holdings?
Obviously, it depends on what happens with rates. If interest rates go up significantly, then prepays slow significantly, and those securities last. Oh, I'm sorry. I don't think I included that.
Yeah, so we have the duration of all the other holdings, but what's the average duration of their Fannie, Freddie, and Ginnie portfolios respectively?
Oh, I don't know off the top of my head. Yeah, I know.
5 years, 5 to 10.
Well,
yeah, I would think.
Absolutely. I think it's in the 5 to 10.
Doug, from what you said, from what you said, it looks like the Fed has the lowest quality MBAs.
They are the largest single investor in mortgage-backed
the quality
securities.
of the portfolio.
Yeah.
It might be lower quality than the rest.
That's, I think, probably a matter of conjecture. They hold relatively proportional to the market shares of Fannie, Freddie, and Ginnie, and they buy them on the run. So I don't think if there is some cherry picking that's in their portfolio, I would argue it's probably been marginal.
Okay, what worries me is the unwinding of the Fed portfolio.
I'm sorry.
What worries me is the unwinding of the Fed portfolio next year. That it will unwinding. Sorry, the unwinding of the Fed.
What's the timing of it?
No, it will be next year probably.
Well, they're already unwinding. They're
Yes.
already they've stopped purchasing securities to replace those that are maturing at a certain pace. They've got a very programmed process. I think it's
Are they selling now?
They are letting it run off now. Yes. They're not selling. They've made a policy statement that they have no intention of selling. Could they change that in the future? They could. It's simply a choice that they've made. But to this point, they're not selling and have a public statement that they don't intend to sell. Okay. Good.
Thank you for two questions. One, the last great financial crisis was really, done by or a large part caused by all the debt related to housing. So the first question is whether you see, the drivers that generated the crisis, whether they have changed or not, or whether we are, creating a new crisis in the making. And the second is related to your comments about the rates in the mortgage rates in the future. What do you see the impact going to be on the housing market and prices in the U.S.?
Sure. So in my view, the primary causes of the collapse in the housing space were speculative overbuilding and easy credit terms, neither of which exists today. I showed you the average credit scores of the current book of production was somewhere around 750. That would be probably 100 points lower at the peak of the crisis. I don't see a push by our regulator, for example, for us to ease credit terms. We've eased them at the margin, but nowhere near where they were in the run-up. And today, the reason for the very rapid pace of house price increase in the United States is primarily a lack of supply or the pace of supply growth lagging the pace of demand growth. I noticed Argentina has some millennials. We have a lot of millennials. They've been telling us since the crisis that they intend to buy houses eventually. 90% of them eventually want to own a home. They're now the driver on the demand side of the equation in the United States. Very clearly, the last 3 years, they've started buying homes. So the pace of growth by that large population group has outstripped the pace of growth of supply, and that's leading to this significant price appreciation. So I don't see those conditions leading to that kind of a crisis going forward. I would say that we have gone through at the company an exercise that suggests the U.S. economy is late cycle. So if you ease credit conditions late cycle, then it's likely if the cycle turns, the very people who you had to ease credit conditions to get into a home would be the first ones off the home on the downside of that cycle. So we are looking at our credit terms to determine that we're not creating that pro-cyclical change. And I think I didn't answer your second question.
Well, the increase in the rates are going to have an impact.
Oh, the increase in rates. The history of the relationship between rates and housing in the United States is, and we ran a test of part of this in May of 2013, if mortgage rates rise a significant amount in a very short time period, housing does not perform well. So we had the taper tantrum in May of 2013. Mortgage rates ran up 110 basis points in about 6 months. What happened to existing home sales the first 6 months of 2014 was about a 10% drop from the run rate prior to that test. So the Fed's aware of that, and our thought is they're going to be cognizant of that potential. But the reason that happens is because household incomes aren't growing at that same pace. So as long as household incomes are growing at relatively reasonable relationship with mortgage rates, the growth in household incomes offsets the increase in the interest component of the mortgage payment for the same size mortgage, and housing does fine. If interest rates are rising because the Fed is seeing an increase in inflation, then they're raising the policy rates to slow economic activity, then income growth slows, and you can get some slowdown in the housing sector as a result of that. So they're well aware of that and the cyclical nature of housing. Were we to see a recession in the near term, it's my view that housing, if it were not a deep recession, housing would actually be the cushion to that recession because of the supply-demand imbalance. So if we went into recession, interest rates would likely fall, which would improve affordability. The pace of home price appreciation would slow. So if unemployment went to, say, 7.5%, up from 4%, you'd still have 92.5% of households employed. Likely, some of those with higher skill sets, maybe the millennial group may well do well in that time period. That might be an opportune time to buy, and housing would cushion the downside and return to its normal cyclical behavior after that. Great.
Thank you, Duncan. Thank you.